interest of time, we wanted to have our keynote presentation. I'd like to introduce David Shepard, who is the president of the CFA Society of Philadelphia, to introduce our keynote speaker today. David.
Good morning. I'm David Shepard from the CFA Society of Philadelphia, and wanted to do a couple things. Thank the GIC. We have a great partnership with GIC. Dom is exemplary of that. He participates on both the board of the CFA Society of Philadelphia and on GIC. To our CFA members, I welcome you here. One of the benefits of CFA membership is that you get discounted rates on events like the GIC conference. And also to highlight the fact that all of our CFA events are open to everybody. So if you're a member of the GIC, we welcome you to any one of our events. And you can find our events, upcoming events, on our website at cfaphiladelphia.org. It gives me a great pleasure to introduce today's keynote speaker, Dr. Catherine Mann. Dr. Mann is the Barbara and Richard Rosenberg Chair of Global Finance at the International Business School of Brandeis University. And she's a visiting scholar at the Federal Reserve Bank of Boston. Prior to coming to Brandeis, Dr. Mann spent over 2 decades in Washington, where she held a number of senior posts, including being a senior fellow at the Peterson Institute, as assistant director at international finance at the Federal Reserve Board of Governors, where she prepared for several international conferences. She was also on the President's Council of Economic Advisors and was an advisor to the chief economist of the World Bank. In academia, she received her PhD from the Massachusetts Institute of Technology, where her thesis was reviewed by Paul Krugman and Roger Dornbush, who all of you know if you took any economist class, you paid many hundreds of dollars to those two. And her undergraduate degree is from Harvard University, where she graduated magna cum laude. Her current research focuses on several areas of external trade, foreign exchange, and technology and trade. You'll find a great deal of research that she's done, including a book that she wrote on Is the U.S. Trade Deficit Sustainable? I hope it is, and numerous articles on trade and finance. In addition to seeing her here today, you'll see her on Bloomberg TV, in a number of media formats on The Economist, in The Economist, and other publications. With that, we're pleased to welcome Dr. Mann, and thank you for coming.
Well, it's a pleasure to be here, and I hope you don't mind too much losing the refreshment breaks, but I thought that since we were sort of a little bit behind time, that it would be good to try to finish up according to the original schedule. Also for my benefit, I appreciate your willingness to do that. So we heard a lot about credit ratings, and I'd like to put that in a broader context of international capital flows and what the situation might mean for the dollar. These are areas that I have expertise, and so we can cross a little bit of the boundaries here between your areas of expertise, which is deep in terms of credit analysis and credit ratings, and my area, which is deep in terms of the international financial environment. So what I'd like to do is I'll probably spend very short time on the big picture of economic recovery because you probably are all familiar with that. I want to spend some more time on issues where credit enhancements matter. I'm going to do a little bit of Monday morning quarterbacking, look back at data that I had picked out to analyze the behavior of international capital flows over the past few years to sort of see where do we think that credit ratings and credit analysis mattered for the behavior of international capital flows at a disaggregated level, both in terms of instruments as well as in terms of geography. That will also lead us into some prospects for those international capital flows going forward. I'll at that point say a little something about credit default swaps, and then finally finish up with just what I think is going to happen to the dollar. So in terms of the recession and recovery, these are charts that I think are very fun to use. They come from the Minneapolis Fed, and they basically allow us to look at the behavior of this recession in comparison to other ones. You can pick any one of a number of ones. As you can see, you've got an entire choice of which recession you might want to look at. The recession is dated from the beginning. That's at the 0 line. And then the trough of the recession is identified by the black dot. And then you can see in terms of output in this recession, which is on the red line, that we have more than exceeded the GDP that we started with at the beginning of the recession period. So GDP is back completely, although this was a very deep recession, deeper than most of the other ones. Now, of course, this is the picture of a similar picture, only for employment. Once again, dated toward the beginning of the recession. The dot is where the recovery is purported to have begun. And as you can see, unemployment or employment continued to worsen for nearly a year, and then, of course, has not recovered anywhere near to where we were prior to the beginning of the recession. Figures for trade, similarly, big drops in global trade. Imports, the blue line, dropped relatively more in the so-called Great Trade Recession, Great Trade Collapse. And then in terms of exports in the red line, you can see that exports indeed have recovered more than from our original period. There we go. And whereas imports are only back to where we originally started from before the recession began. Now, this is the picture for international capital flows, and it gives us a starting point for where we can start to look at this decomposition of international capital flows that I think is important. So we take it back to 1995 to give you a little bit of perspective. The red line here is foreign purchases of U.S. assets, so of course that's capital inflows. The blue is U.S. purchases of foreign assets, so that's capital outflows. The 2000s period, especially the latter part of it, really indicative of a dramatic expansion of cross-border international capital flows, both out and in. The jagged here is just because these are quarterly data, but you can see the trend is very clear. You can also see that the collapse in the financial crisis is very obvious there in 2008. It's notable though both of those lines cross the 0 bound. In other words, and this is something that is unique in the period of looking at international cross-border capital flows. You can take this series back to the 1970s, 1960s, and it is only in this period, in this 2008-9 period, that everybody's money went home. Basically, those negatives implies that the locals took their money home. You can also see that just as GDP growth in the United States and in Europe we're starting to recover in 2010, you can see again in the 2011 that international capital flows are really a bellwether for what is happening more generally both in the U.S. and around the world in terms of sentiments, attitude towards risk, and the desire to take on international investment positions. So as I say, that gives us a starting point for looking back at that period of time when the international capital flows was most robust in 2006 through 8. Kind of what were the leading edges of those international capital flows? Who was investing in the United States, and what kind of instruments were they using? And I'm going to focus on sort of the red line there, which is the foreign purchases of U.S. assets, not because the other one isn't interesting, but the foreign purchases of U.S. assets actually are more interesting than the U.S. purchases of foreign assets. There's more diversity. So here is a chart that goes back to 1998 and then goes to quarterly data beginning in 2008 Q1, which is here. Okay, so this is a picture that I used. This was a picture that I used to look at the characteristics of foreign official investment in official U.S. assets. So this is basically foreign central banks buying U.S. Treasury securities, both short and long, and agency securities. So what you see there is long-term U.S. Treasuries are in the red, short-term bills and bank facilities are in the blue, and then, of course, the green is agencies. So you see that the building up of foreign purchases of U.S. agencies was obviously because they got higher returns, but in their view, those agencies had exactly the same risk as a U.S. Treasury security. Now, of course, they weren't supposed to have exactly the same risk as a U.S. Treasury security because they weren't supposed to be guaranteed by the U.S. government. That was something that had been on the table for a long time. We dealt with it at the Fed in the 1990s. But in fact, everybody did believe it was going to be a U.S. risk, a U.S. sovereign risk, and indeed, of course, they were right. When they got out, which was in 2008 Q4, they got US Treasury, out of the U.S. agencies. That big green bar is really low. What did they transfer into at that time? It was the short-term U.S. Treasuries. The big players here, of course, were China. Not the only one, but they were the biggest player. They were one of the biggest holders of U.S. agencies back in the 2007-8 period. They really built up an exposure to U.S. agencies. So if somebody wants to talk about political economy, the dance on how Fannie and Freddie were going to be treated in terms of sovereign risk had a big dance between the U.S. and China on that score. Another player, however, is in the bottom box, the Cayman Islands. I always like to look at the Cayman Islands to see what they're doing. And they had a pretty good exposure to short-term U.S. Treasuries. Looking over on the right-hand side, you get they owned 5% of short-term U.S. Treasuries outstanding abroad, and basically 5% of short-term agencies. So the Caymans also, even if that is a U.S. investor's exposure, it is considered to be foreign because, of course, it's outside of the country. Now, credit enhancement also mattered for European purchase of AAA-rated asset-backed bonds. So looking at 2002 up to 2007, the red is Europe exposure to bonds, and the hatched red is the UK. So in terms of total exposure to corporate bonds in the United States, most of that is asset-backed securities. Caymans are also a very important player here. They're in the green, Caribbean financial centers. So you can see what the implications of the collapse in the asset-backed securities market is for financing the U.S. External accounts. 2008 and follow on, you see that there's absolutely no appetite and continues to run off those asset-backed bonds. Lastly, if we take it up to the present, lack of credit enhancement matters as well. The gray bars here indicate the cross-border funding through the interbank system. You can see in the first 2 quarters of 2011, and the data actually only go through Q3, so I'm not missing too much here. There's an awful lot of sloshing of money across borders as interbank markets seek to figure out where they need to have their funding in place so as to have it when they need it. This is, of course, very short-term money and very volatile money. The other observation that you can take from this chart is once again the amount of funding that came through the bond portfolio, bond and mostly bonds, in the red, a little bit of equities there, again, completely disappears as a funding source for cross-border capital flows into the United States. And all of that is replaced with foreign purchases of U.S. Treasury securities. The blue solid is official purchases of U.S. Treasury securities. And then there are, even in 2011 second quarter, you saw that the private holdings of U.S. Treasuries started to run off. So in terms of financing, in terms of a bottom line story on the role of credit enhancement or credit ratings, they play a very big role in the composition and level of the financing of U.S. external accounts, because of course foreign purchases of U.S. assets is the counterpart to the trade deficit that the U.S. economy continues to run. If we look at the gross flows, I think you continue to see that that credit enhancement or credit capabilities or credit risk really continues to matter. The three lines here, oops, I don't have lines on them, I don't have labels on them. Gross flows, purchases and sales by foreigners of U.S. Treasury securities. The middle line is of equities, and the bottom line is of bonds. So you can see that like microscopic difference in the bottom lines between the green and the purple line, that was those very large, at least in terms of the importance of financing the U.S. external balance in, say, 2004 to 2006, that very large European purchase of asset-backed securities, principally asset-backed securities. So even though the gross flows are pretty small, the net flows are really quite important. Going forward, I think that one of the interesting questions that we have is there were a variety of things that foreigners could purchase other than U.S. Treasury securities that, in their view, offered them a low or near zero risk environment. They were the AAA corporates, they were the agencies, and now they kind of don't have anything. They're afraid of the corporates, even though there's probably a lot of good corporates around that aren't asset-backed securities. You know, they're not buying them. Afraid of the equities. Agencies aren't there. So what are they going to buy instead? So these are data from the flow of funds, and it's annual data up until 2009, and then quarterly data after that to the third quarter of 2011. And now you can see that the two scales are like 100 orders of magnitude off from each other. These are both a percentage foreign purchases of, I call them no default assets. It's not quite right, but bars are municipals as a share of total financial assets, so foreign purchases of U.S. assets as a total, so municipals as a share of that on the right-hand axis, topped out in 2009 at 3.5% of foreign purchases of U.S. assets in total, whereas in the same period, the percentage in 2009, U.S. Treasury securities as a percent of total financial assets was 300%. And of course, that's because all of the other assets were running off. They were going into Treasuries to more than offset the runoff of the other assets that they were selling. Nevertheless, I think that the picture here between the line and the bars is evocative in the sense that municipals, although they are a very, very small share of what foreigners are buying, they do represent an interesting alternative asset for those foreigners who are looking for the quote, non-default asset that has a relatively higher rate of return. And even though these numbers are small in terms of percentages, 1%, 1.5%, when we think about the total financial assets that are being purchased here are in the 2.6 trillion, you're talking about real money to the municipalities. Now, whether or not they actually end up being no default assets, I think that's, of course, an interesting question, but we heard a lot about that this morning, and that's why I wanted to put this picture in here. So let me turn now to talk a little bit about credit default swaps. These data and graphics come from the Bank for International Settlement. And I think the three charts that you see here add up to the conclusion that what matters about credit default swaps is counterparty risk, not payment risk. So let's start why I believe it's not payment risk. And then looking over here at the right-hand side where it's CDS relative to government debt, it's in the 4 percentage points for Portugal and 3 percentage points for Ireland And even Greece, it's 2 percentage points. So the total amount of exposure, not net, for two credit default swaps is really, really small. It's very, very small. In contrast, if you look over on the left-hand side, it's the gross outstanding volume in billions. So it's a big number for Italy, Spain, Greece. These are big numbers. These are really big numbers. 2 years are shown, 2009 and 2010. It's increasing, of course, for all of them. So it's gross. There's a lot of volume in terms of credit default swaps. Even when you net them against each other, you still have an awful lot of volume left over. But if you actually had to pay out against government debt, it's pretty small. So what that says to me is that credit default swaps are basically, there's an awful lot of naked ones out there. There's an awful lot of volume that represents bet taking. And that therefore, since they are not netted against each other in a clearinghouse, since we don't know who's taken the bet on whom and who's issued, that we're looking at a network risk, and therefore a counterparty risk, not so much a risk when we bring it down to the government level. In terms of the role that credit default swaps play in price revelation, we heard a little bit about that already, but these three charts look at the relationship between the spreads, the bond spreads, the sovereign CDS premia in the center, and then what the implication of that is for the euro exchange rate. The yellow is against the dollar. Up represents a euro depreciation. So indeed, as the attitude towards risk or the pricing of risk as represented by either bond or CDS is associated with a period of time when the euro depreciates, as to whether the sovereigns lead, whether the CDS premia lead the bond spreads or lag the bond spreads, that's a very important question. If CDSs actually represent a leading indicator of the bond spread, then you could say that there is price revelation there that is not being taken in the bonds itself, and that it therefore represents a market that we'd like to have mature so that we could kind of use it as a leading indicator. The research on the corporate side finds that CDS spreads lag, that CDS, in fact, is not a leading indicator of bonds. And some of the preliminary work that I've seen done on the sovereigns suggests the same thing. That further indicates that sovereign CDSs play very little role in the revelation of investor attitude towards risk, and therefore really ought to be considered as I say, a sideshow, a bet taking, really not something that is useful for us to understand investor attitude towards sovereign default risk. So what does this mean for the dollar, implications for the dollar? So a number of years ago, I looked at the question about whether or not foreigners were overweight U.S. exposure. And that was, if we looked at their portfolio, foreigners, and we looked at their portfolio of wealth, and we expanded their portfolio of wealth, and we said, if their expansion is all put into dollars, what percentage of the expansion of their portfolio of wealth would have to be put into dollar assets so as to keep the dollar unchanged? So I did that exercise back in the 1990s, the latter half of the 1990s, when the dollar was at an appreciating phase. And in 1998 to 2000, what I found is that foreigners would have to allocate 79%, basically almost all of the increase in their wealth into U.S. assets for the dollar to remain unchanged. Well, of course, that's kind of a high number, well in excess of what anybody wanted to do, and the dollar started to depreciate shortly thereafter. I can do that calculation, and again, actually the same methodology, but a much better data source, the Coordinated Portfolio Investment Survey of the IMF, and do that same calculation for the 2000s, and I find that a much smaller percentage of an increase in the foreign investor portfolio did get put into U.S. assets. So the 79% was an estimate, and in the 2000s, these are the percentage of the increase in foreign portfolio of assets that did get put into U.S. assets. So you can see it's a shrinking percentage between 2007 to 2009. So very small percentages of the increase in foreign investor wealth was actually allocated to U.S. assets. So that's one piece of information about my expectations for the dollar. The other piece that I want you to look at for expectations for the dollar is to look at what the dollar actually does over this time period. So we take it back to 1973, which is the beginning of the floating rate period. These are the dollar indexes from the Federal Reserve. And so we have the three of them. The red is the majors. Those are the market-based currencies. The blue, other important trading partners, the indexes that tend to be more highly managed. And then the green, which is the combination of the two. The reason for putting this chart up here is twofold. One is so that you can observe the extent to which exchange rate management by the blue guys is in fact very effective in keeping their exchange value of the dollar above what it probably would be based on a less managed situation, which is what we observe on the red. The other point to observe from this chart is that the dollar is lower than it has ever been before. And what that means is everybody else's currency in real terms is collectively above where they have ever been before. And so that puts a lot of stress on a growth development strategy that many countries, at least in the blue category, have put on growth, meaning export-led growth. On the red side, we already know that there are a number of countries that have sort of put the brakes on further appreciation of their currencies, drawn the line in the sand, Switzerland being the obvious candidate there. But we also know that Europe, in its effort to kind of come out of its own sort of growth problem, is looking for exports. So there's a number of reasons for why the dollar being as low as it's ever been probably suggests that it's due for a rebound. So where do I come out here? Credit ratings and other attitudes towards credit risk and measures of credit enhancements has implications for international asset allocation. It really does show up in terms of the behavior and the composition of foreign purchases of U.S. assets. If we think about going forward, private portfolio allocation, my view is by looking at where foreigners actually did allocate their money in the 2000s, the composition in the U.S., there is plenty of headroom to allocate towards U.S. assets, but there may not be any appetite. They can, but will they? On the official side, own currency appreciation is very harmful to the exporters and growth, so they don't want their currencies to appreciate anymore. On the other hand, they're also overweight dollars, so they don't really even want to, they don't want to buy any more of those assets. Naked bets, I think, have played a very big role in what's going on in the international markets. So if we put all those pieces together, in my view, that we are basically looking at a period of very high volatility in the dollar, what I call porpoising, as investor attitude about which is a risky location or a less risky location, and the ratings play a role in that the dollar was just going to porpoise in a range similar to what it did back there in the mid-1990s, mid and early 1990s. So that's my linking of the credit ratings, international capital flows, and my prospects for the dollar. Thank you. I think I have 15 minutes, so I can take cues or you can run and give Norbert and Peter an opportunity to take your comments. Yeah. Yeah.
Any questions?
I can just try to really loud what's going on.
Yeah.
What about Japan? You have such big numbers there, even compared to some of what you showed on the screen. Any comments on their situation?
On Japan's situation with regard to international capital flows?
Yeah, you know, their outlook.
Well, Japan's outlook going forward with regard to ability to get international capital flows, they have such a strong domestic investor base that I look upon them as being very different from the United States. They have a consistent surplus. We've had a consistent deficit. They don't really need to borrow in international markets. So, the picture that I think of for Japan is really doesn't look similar to the United States in virtually any way at all.
Risk aversion of the private sector and the official sector, because with our twin deficits, neither of which show any signs of being diminished, either in absolute terms, stock terms, or a percentage of GDP terms, the official investment managers, China, Japan, and so forth, have no choice whatsoever. They've got to continue accepting dollars in their portfolios, but the private sector obviously is very tempted by growing access to the renminbi, for instance, or other even euro assets. So the divergence between these two different sectors, I should think, would be very important.
Well, we've seen that. We saw that divergence starting in the crash period, right? The private investors changed their allocation completely away from private investments, private investment vehicles, to U.S. Treasury securities. The private guys did. The official guys did too, and so that was, that's one reason why we have Treasury rates at what they are now. It's not just that the Fed is buying them; everybody else is too. So you suggest, though, that that the official guys have to buy U.S. assets, and I think one of the interesting observations that I've made in other places, but wasn't going to fit here, is that China now has a bigger trade surplus and trade relationship with Europe than with the United States. So if we think about the story that China has to buy U.S. Treasury securities because they have to, they depend on the U.S. market for their exports, that is much less true now. They depend more so on Europe than on the United States. And if we think of the euro and the dollar as going in opposite directions in terms of exchange rates, dollar appreciation is euro depreciation and vice versa, then the renminbi pegged to the dollar gets to sit right in the middle, right? Because half of the trade is with Europe. If we just take China, say exports are half to Europe, half to the United States, which isn't quite true, obviously, but just leave it that way. Then the renminbi pegged against the dollar is effectively a basket of 50% dollars, 50% euro, and it can be flat. So China doesn't have to buy U.S. Treasuries anymore to maintain its export growth. It can buy euros, which is, I think, why you see such interest and offering of the Chinese to assist in the recapitalization of Europe, because it's in their interest to do that, just as it was in their interest to buy U.S. Treasury securities, over the 2000s, since 2004 in particular. You can go to the airport. Yes. Well, thank you very much. Thank you.
All right, questions for, we can take questions for Peter or Norbert if you have any, or you just want to catch them out there. We got a book signing going on, so. All right, well, let me just thank you all for coming. Thanks to the organizers. Dom, this was great. Thank you all. Thank you CFA. Thanks, Fed, for the location. Always appreciate the support. Take care, travel safely, and we'll see you at our next event.